Hi, this is Randy Finney with Right Side of the Chart, and this is a market wrap for Thursday, October 18th, 2018. Another volatile day in the market, and like I said, that's to be expected right now. When volatility spikes, it usually doesn't do so for one day. We have a period really until where I think it'll end once this correction's over. And I don't think it's over yet, but I'll go over the charts. Let you be the judge of that. So real quick rehash. This is the S&P 500 E-mini futures. That's that ramp we had on Tuesday. Now, what I wanted to point out today, what's technically significant, and the reason for this video, is we've now faded all of that rally today. So you can see the market giveth, the market taketh away. And so, although that day definitely got a check mark for the bulls, today gets a check mark for the bears, and even more so. That's yeah, pretty bearish to see such a big move faded so quickly. And again, was pointed out the time right when we closed on Tuesday, we are just shy of this level here, 28.26. Mentioned as an objective shorting level for the ES, and there's of course resistance on SPY. QQ SPY was above resistance, I should say, on the daily, but QQQ had some resistance levels we'll get to. So either way, that panned out. Now the $1 million question is, where do we go from here? And that's why I'm doing the video. So you can see we came right back down at the lows to about where the apex of that triangle was. You can see that little triangle pattern there, and as of now, the momentum indicators, especially this PPO on the 60-minute chart we're looking at, is clearly pointed lower. Those things can turn on a dime. That's what happens in volatile markets. So it's still anybody's game. But again, you have to give this to the bears today, and more so, not just that we're down, but we failed at a lot of resistance levels that I pointed out recently. That back test on XLK, the technology ETF. We'll get to the charts in a second on SPY and QQQ. And I want to show you something on IWM that I haven't showed you recently. So let me just look at NQ real quickly. Same story that on Tuesday we rallied right up to, as I pointed out there, a pretty significant, very significant resistance level, 73.44 or so. Obviously proved to be a very objective shorting level, and we got down pretty quick. So we faded those gains there again, and came right back to that apex, that little triangle right there. So we'll pick this up tomorrow. We'll see where we go, and I'll give you, I've already shared my thoughts on the site and in the trading room. I'm still leaning towards that, another big leg down, and just like last week, I think once we hit that second POR, what I call point of recognition, or the WTF moment, where the longs and bulls and everyone realizes, wait a minute, something's wrong here. This is where the market should have held support. That's where you get that waterfall selling. We're not there yet. Somebody asked today, are we going to hit that? Could be there tomorrow, or we could bounce tomorrow. Again, we only came back to about the midpoint of this consolidation range. So that in itself, although I don't have a support line drawn, there was a lot of buying that took place here. That was a battleground between bulls and bears after this initial low we got up here and consolidated. We'll have to have this area resolved. A break below there obviously would be bearish. That starts clearing out. There were a lot of trades that occurred in there. So the bottom of that level is certainly support. And if it gets taken out, although there is this previous low, I think we just go down there to it. That's not a lot of trades. That was a quick whoosh, in and out reversal. So this is where trading stabilized, if you will, even though it was choppy that day, those couple days. So those are levels to watch. Watch those recent lows on NQ and ES as well. Same story, or the bottom right here, I should say, on ES, the bottom of that recent range, cut a line right about there, bring it over to a little bit under 27.50 or so. And I know a lot of you don't trade futures, so let's look at the charts. Here's QQQ. So what happened today? Let's look at a clean board here if we can. That's definitely not clean. Here we go. This is a daily chart of QQQ. And so when we zoom in nice and tight, we do now have the potential that this was although it's a little bit stretched, it's still within the possibility of a bear flag pattern, and it's very large, and so is this move leading down. So if that will play out, and by the way, this has all the makings of a bear flag. When you see a breakdown out of a bear flag pattern like you had today, you want to see it impulsive, and this is the definition of an impulsive candle, as is this and this, the breakdown that happened back here, that first candle. The way bear flags usually play out, the move leading out of the flag, the move down, is just as impulsive as the flagpole leading up to it. So, tomorrow will tell us a lot. If we have a big red day tomorrow, um, if I were you, I wouldn't want to go home long over the weekend. Let's just put it that way. So we'll see what happens there. And so far, so good. Let's look at SPY real quickly. SPY, same story, and actually some other things to make mention here too. So there's SPY. We zoom in nice and tight, and we can look at the same bear flag pattern on SPY. Let's see here, a little glitch there. All right, so there it is, nice and clean. Like I said, a little big, but not too large. There's been flags that can certainly get this size. And again, you had an impulsive breakdown, and so that's one thing. But then we look at let's look at what happened price-wise. This was at big level, comparable to 2,800 on SPX, the S&P 500. This is SPY, the tracking ETF, so I have it at 279.26. Comes in around the same reaction points. That was a good support level. And so on Tuesday's ramp, which I undoubtedly, as I said in the trading room, undoubtedly had a lot of short covering. How much of it was natural buying? Obviously, a good part of it. We'll never know for sure, but it doesn't take really a genius to figure out that a lot of shorts that piled in, especially what I call the Johnny come lately shorts, those that didn't want to short here on the breakdown or back test or failure, or even here on the secondary breakdown, but they wanted to come in here, they had to be squeezed out. It's just, if they weren't, they would have felt a lot of pain. So that's the thing about shorting. If you get a swing trading, you get a nice entry up here, you can ride those positions out, and you will get back some profits on the kickback rallies, but you don't go red. So either way, that tends to squeeze a lot of people out. Big move. Imagine if you shorted at the bottom there. That's almost a 4% rally in SPY to the top. That's just SPY. QQQ was even more than that. And again, I always say this: keep in mind the increased volatility and what it means if you're trading leveraged instruments like NQ or SQQQ or TQQQ. Always do the math. And if you don't know what I mean by that, well, right now, a 3% day or intraday swing is really the norm lately. So in one given day, if whatever you're putting in there, and 3% unleveraged. So multiply that by 3, and you're talking, 9, almost a double-digit gain or losses on SQQ and TQQ in being on the wrong side of a trade in just a single day in this market. So you have to, take your pencil out and do the math, and then again, stops will prevent you from getting there or taking the full brunt of that kind of loss being on the wrong side of the trade. All right, so the point I wanted to make here, other than that, sometimes I will digress, but I think it's important in this market. People can make a lot of money and people can also lose a lot of money. The point I wanted to make is we took out that level, hooray, hooray, stood above it next day, even after dipping back below it, successfully defended it, put in that little doji candle, but boom, failed it today. And as soon as we failed, you can see we went above it, we couldn't regain it, and that's where we were rejected. So I know this sounds, I'm going back and forth. Tuesday was check mark for the Bulls. Today was a check mark for the Bears. So the analogy I use, it's like watching a good old, heavyweight fight with two sluggers, and they're just exchanging blows round after round, and today the Bears took the round. Tuesday the Bulls took it. So in the bigger picture, I've shared my thoughts where I think things are going. So we'll see what happens there. And of course, let me talk on QQQ real quick about levels. I already talked about the flag breakdowns, but the big levels to me are 178. I've gone over that before. Lots. I think it's a very important resistance level. Lots of reactions along there. Breakout to new all-time highs that we danced on for a while, and then we gave up that level. We broke down, and the fact we had this big impulsive candle once we lost 178 helps to validate that level. And again, as said yesterday and before, that was an objective short entry area to short, and it still would be if we get there again. If we take it out, I would not be adding short positions a penny over 178. You can short all the way up to there. You can hold and put a stop above in case they try to run it for a day or two. But anything above there, you have to question the bearish scenario at that point. So That's just my thought how I would trade. I wouldn't necessarily stop out over 178, but I certainly wouldn't add and dig myself deeper into what could prove to be a hole if that level's taken out. And the other levels mentioned in the past, 170, really 174 to 175, depending on which chart I'm looking at, intraday 60-minute, 15-minute, 174 all the way up to 175 on the daily chart seems to be a key level. If we stopped there the other day, you can see right here, and we lost that level today, and we also lost this trend line. So that's that. And now let me show you, let's jump out to the weekly charts, show you what's going on there. Okay, so here's that big trend line I'm watching the off the 2015 lows and QQQ on the weekly chart. Remember, they stick saved it last week, took it down intra-week, but managed to park it right back on there. And that key 40-week, which is also the 200-day moving average, exponential moving average. But look where we're at now. We are back in a precarious technical posture. We were at some point this week well above there. And as I said from my experience, usually when you come down after a sharp correction and kiss long-term trend lines and key moving averages like this, that's it. It's usually one and done. You're off to the races. And that's how it's been. That's how it was, at least on these last two tags. So far, that's not the case. We rallied and then puttered out so far, and we're right back on that support. So the reason I thought last week before it even happened. Okay, I had to pause the video there for a second for an interruption. Trying to recall where I was, but I believe I was talking about that bounce. So now we're right back to it already. So it doesn't mean we can't have another test. Doesn't mean we can't test it for 3, 4, 5 weeks. It just means right now there's zero margin for error. We are once again walking the line. We're on a razor's edge right now. Again, all that matters is a weekly close. But if things play out like I think they might, if we have another red day tomorrow, and over the weekend we see futures tank, and then we gap down on Monday. You could see that. Well, tomorrow's Friday, so we're going to print. Let's see how we print this. If we print right around there, a hair below it, still anybody's game. But if we somehow have a big down day tomorrow, print a solid close, Qs have lost support for the first time since 2015. They have given up two of the what I believe to be the most important support levels, this 40-week and the trend line. So that's QQQ, and that's, QQQ is really the market leaders. That's holds most of the market leading stocks. SPY, the trend line that we have on SPY is actually the bull market trend line. It comes to the left of this chart off the 2009 lows, March 6, 2009. There's the trend line. We're dancing on it now, a hair below it, but again, parked right on that 40-week moving average. You can see it there. So again, zero room for error, and we're below trend line support. And I told you I can play a little bit around with this trend line because of the choppy candles there. So if I wanted, I could move it a little below. But this is the draw I prefer, and we're below that now. So any way you want to spin it, precarious technical posture. And again, it's everything else that's happened. Things I haven't even mentioned in recent videos, but I put up on the site. I put up divergences and trend lines on things like this percent of stocks trading above or below their 250-day moving averages, the NASDAQ advanced declining issues, all other type of things that talk about market breadth, sentiment, and everything else. So that all plays into my analysis here, not just these simple trend lines. I mean, I try to keep my analysis and the trading and things I share on the site pretty simple, but I can tell you a lot of factors go into all this. So that's where we're at. And now let me show you one more that I haven't updated in a while now. If you remember the site, we just had a short trade on this recently, IWM. We went long TWM, which is a 2-time short. I expected a pretty swift drop down. That's why I used a leveraged ETF. The leverage works in your favor when you get those unidirectional moves. Now, keep in mind the index ETFs don't really have much decay, so they don't really work too bad or against you, especially only 2 times. But the 3-time leverage ones, especially sector ETFs, though, those can really really work for or against you when you use them. But what I mean by a unidirectional move is what we had in IWM recently. It just, there was almost no kickback rallies until late last week. And now this is what I wanted to show you because I haven't highlighted this recently. Just a beautiful, beautiful textbook bearish rising wedge. I had two trend lines, my preferred trend line, the upper one, and then that alternative BOD or benefit of the doubt trend line. Both were taken out a couple weeks ago. There was your divergence, negative divergence, divergence a high, just like you had a divergent high here in a bear market. IWM, the small caps did fall over 20%, so technically they hit, if you want to call it that. You can call it a correction in an ongoing bull market too, but that's that. So I wanted to just point out um, how clearly bearish the small caps look to me right now. Certainly could kick back, but we're not even oversold on the weekly yet. So, when I see a clear and solid breakdown like this, and what I'm talking about is, some breakdowns, you break down your little bit there and you may kick back and snap back up there. But at this point in time, that's an unmistakable breakdown. And all the impulsive, those two big red weekly candles, especially last week, helped to validate that. So, uh, before all is said and done, I think IWM goes down to about that 144.20ish level. Okay, and to bring this video home, let me share something. I've mentioned it in the trading room. I've mentioned some of these on and off sporadically over the last few weeks. And what I'm referring to are the market leading stocks, particularly those big tech stocks. So let's just go through those one by one. Here's Apple. Apple's been a holdout as far as compared to, relatively speaking, for all the FANG stocks, it's actually held up the most. But I posted this in the trading room, and I've covered this chart quite a bit recently. Apple is in a very precarious technical position right now. This 26, we'll call it 216. Move that line down a little, 216-ish. Volatility you're going to move up and through, but that is a well-defined. This is a daily chart we're on, guys. And I have this primary trend line, which already broke down. We had an impulsive breakdown. We're still below it, the blue trend line. And then this yellow, what I call BOD trend line, because I come in here, I catch one reaction there in addition to that initial reaction, and then all the reactions recently. And we broke that today, too. So all we have to do now is give up 216 with conviction. Again, sometimes you have a little intraday break and a snap back above, but this tells me they're just buyers aren't stepping in. And what I feel really good about right now, and I'm sorry if I'm speaking like I'm from the dark side, I'm just right now my position is short and I think we're going down, is that I've checked and the FANGs, I don't have to worry about any of these market leading FANG stocks blowing me out in the next few weeks. I have enough time. My scenario plays out that Apple will break below, whether it's tomorrow or next week, come down before earnings, come down, hit this first target, bounce, and probably right around, I think they'll rally it into earnings because everybody loves Apple. It's just like that sitcom, Everybody Loves Raymond. Everybody loves Apple, so they're going to buy it. My guess, and right up to about, they report after the bell on November 1st, so either November 1st or November 2nd, the first day it starts trading. That's probably when they'll start fading any rally if we get one leading into earnings. And we don't have to get it, but that's the scenario I laid out in the trading room today, and then ultimately come down here to that 181.71 level. And market, if that happens, market's going to feel some pain. That's about a 16% drop, but this is the drop I'm looking for initially, and that jives roughly with my expectation on the broad market. So there's Apple, and yeah, let's move off. Let's just focus on that 116 level. The rest of them, and this is a common theme I'm seeing. Amazon already broke down that clearly. I've gone over this. We outlined this wedge breakdown, back test, and again, like I was talking about recently, this looks to be just an initial leg down in a correction, and this appears to be a counter trend bounce, which takes just perfect form of a bear flag here with a breakdown today. You can see the impulsive move down. Now it needs a little more work to do. Let's get under this 1766 level. But if that flag plays out, as I suspect it will, because there's just so darn many of them right now, as I said on the site today in the trading room, either this is one of the best laid bear traps that I've seen in a very long time, or this is a real deal. And if they're bear traps, and whatever, short these stocks, just cover above. If they foil these flags and and take it up there, you can have a stop a little bit below. I'm sorry, a little bit above those. But that should bring us down when that flag, if and when it breaks, which looks like it broke today. If there's follow through tomorrow, impulsive selling, that should confirm it, and we're coming down here to my second target zone. And again, October 25th, that gives us a week to play with Amazon on the short side and not have to lose any sleep at night worrying about being caught on the wrong side of a big gap. I could show you as well on Microsoft. There it is. We have to take all these annotations away. So you can see the common theme I'm getting at here. Bear flag city lately, and on a lot of these market leading stocks. And by the way, it extends to some some financials as well. I'm just rifling through the QQQ components right now, which are mostly tech stocks, pretty much all tech besides Amazon. But you can see it. Look at Alphabet. Boom, right down to that target I have there, about 1,000. That's GOG. Of course, you can see it on the other share class too. GOGL, same story. There's your flag. And let me show you one other thing. Let's just go to the SPY components real quick. There's the flag on SPY I already showed you, but here's Berkshire. Berkshire is one of the top 10 holdings in the S&P 500, one of the largest. It's not in the NASDAQ 100 because the NASDAQ 100 doesn't hold any financial stocks. Zero, no exposure there. So that's what makes it also not a very diversified sector. I always say, I jokingly refer to QQQ as XLK with an Amazon kicker. It's basically a tech fund or a mirror of XLK, but you have Amazon and of course some other companies in there, biotechs and other stuff, but no financials. But look at that big bear flag on Berkshire. Take us right down to that gap. So there's just too much right now, and again, they can foil these because a lot of these flags, a few have just started to crack. The others haven't broken down yet. So anything's possible. And, in an overall primary bull trend, I can tell you if they break these down, suck in a lot of shorts, and then blow it and reverse it and go the other way like this, and just as it starts to look good, ramp it up. It wouldn't be the first time I saw that, but I just don't see that in the charts right now. So you can sit here all day long and say what can and will happen, what's happened in the past, but as of now, these are the scenarios I'm looking at. And again, if you you short this flag breakdown or any of these, just set your stop above the top of the flag. That's why I love bear flags. That's why I love trading things like bearish engulfing candlesticks and other candlestick topping patterns. Because if you get one, let's just say you have one. Oh, there's one right there. There's a hell of a bearish engulfing on Berkshire. Um, the way you trade these is you see the bearish engulfing and then you set that, usually they're not that big. You just set your stop above either above usually I like to set it right above the top of the bearish engulfing candle. And again, they're usually not that large. And in this case, you can see you also have former support in that gap, which is now resistance. So you can short Berkshire right here, any bounce back up to 212 with a stop a little bit above it as well, and or wait for a break of that flag, and there it is. So that's it. I'll wrap it up here. I just wanted to point out that I'm spending a lot of time on the index charts, but when like I always say, any index or sector is simply a sum of its parts, and that's why I like to look at. We don't need to look at 500 stocks to analyze the S&P 500 or 100 stocks to analyze the NASDAQ 100. We only have to look at the top 5 or 10 because they make up the bulk of the returns. NDX is so top heavy weighted that we can just look at the top 5 or 10 stocks. If you can figure out where they're going, you can guarantee that you'll have the call right where QQQ is going. Let's wrap it up here. This has been Randy Finney with the right side of the chart. I hope you enjoyed it.